So, hi guys. Today I'll be covering a few companies which are in the wealth and asset management space. So, these are very leading companies. They're very large companies, but the market itself is changing in such a way that I'm covering all of these together, and I'm just highlighting what are the changes structurally that are happening in the market and why it is a space that everyone should at least look at. And full disclosure, I might or might not be invested in them personally, so I'm not giving any recommendation. It is not buy or sell advice. I'm just sharing my own thesis. So uh, we have seen that wealth and asset management companies like Nuvama Wealth, 361 Wealth and asset management companies are basically like HDFC AMC, Aditya Birla Sun Life AMC, Nippon AMC, or UTI. These are the listed players. So these people will basically be making mutual funds and getting fee revenue out of those. Um, all right, so a very short slide on what do they do. I'm basically going to cover AMCs right now. So they basically get paid to manage your money. So let's say you're a person who has some savings. So you can either put them in an FD, you can put them in a savings account, or you can buy some real estate or gold with them, right? With the savings. But any part of that you want to buy as equity through a mutual fund, you'll have to go through an AMC. You cannot just directly make a custom mutual fund. You'll have to choose from the available schemes that are issued by these fund houses. So AMCs will charge you a fixed recurring fee that is based on the AUM. So if you're investing 100 rupees, so they'll take a percent of that 100 rupees. And if it turns to 200 next year, if it grows by 100%, so next year they'll be charging you the same percent on 200 rupees basically. So that is how their revenue scales. Either they add new clients or the money of the existing clients, it grows a lot. So that's the two ways they can make more money. So, wealth management is traditionally less cyclical than asset management. So, wealth management essentially includes firstly, it is catering to HNIs. So, HNIs have more sticky money. So, they won't get very easily scared if the market dips a little, let's say 10-20%. They won't pull their money out as easily as, let's say, a person who's very new to the market. So now what has happened is that there are not many big wealth managers which are only wealth managers. Let's say there's 361 Nuvama. So they are also asset managers. They also have their own funds now, own, PMS schemes, whatever. So earlier what used to happen is that let's say a wealth manager that is Anand Rathi Wealth, Anand Rathi, it has a client who has 100 rupees. So Anand Rathi Wealth might be suggesting the client to add 20 rupees to HDFC Flexi Cap. And Anand Rathi will get paid a commission fee on that, which is also recurring. And it will also, benefit HDFC AMC, which will also make money on this. But uh, Anand Rathi Wealth has clients which are more sticky, which it is always talking to. It is, maybe going to their house to collect the money, or it has a relationship manager for every 10 clients. So they can persuade the client a lot more, and they have a relationship with the client. That is why they make the large money out of this. So Anand Rathi Wealth can actually make more money distributing the fund than the AMC makes. So traditionally, this was considered a very good business, and that is why Anand Rathi trades at like 60 times trailing earnings, because their revenue is very sustainable, and it is very visible that they'll make around this next year and they'll grow around this amount next year and the year after that. That is why they get a very good valuation. And AMCs, on the other hand, they have clients through the wealth managers, yes, but a lot of their client base is retail. And retail money traditionally in India, it depends on the market. So if the market goes up, there will be retail inflows which will increase. And if there's a bear market or a correction or a market slowdown, this retail money goes away very quickly. And it is at a time where the AUM will automatically decrease because of the fall in stock prices. So when they're gaining revenue or clients, they're gaining more clients, more flows, fresh money coming in, and the market is also going up. So the money of the existing client is also, giving them more fee every quarter. But when this happens in reverse, it is a very bad time for these AMCs, which is why they have never gotten, 60, 70 times trailing earnings multiple. But there's a very significant shift that is happening in India, that people were earlier not comfortable putting a large part of their savings in equities, and they would rather go for FTs, fixed income options, and real estate or gold. So assets in equity are still single digit, but this is going to get bigger than FTs and gold combined in some time, I would say a decade or so, if we follow the path of other developed countries. So it's a big if, but there is real momentum here. And we're only getting started because we're still in single digit. There's at least a 4 5x growth that can happen from here in the next 10 years. So if the share in savings goes up to, let's say, 30% eventually, uh, the overall pool of savings will also maybe go up 3 4 times in the next 10 15 years. So when that happens, the growth in the equity portion will be like 8 to 10 times, which is very large. And the interesting part is that the growth is not slowing down even after a very, brutal market of the last 2 quarters. It was very volatile. And interestingly, the month of June saw a new highs, an all-time high in SIP inflows. So this is a very, it's the best indicator you have as to, the SIP or the sustainable or predictable money coming in, and that is at an all-time high, even after all the volatility in Jan, Feb, March, April, May, and June. Uh, the markets have not hit a new all-time high, but the SIP flows have. So this is a very big sign, and it has never happened before. That So usually, what used to happen is that after a few bad quarters, the AMCs would actually have negative growth and a very sharp decline in revenues actually, which is why they would never get the valuations of some sustainable growing companies, because these companies are diversified. They do not have much regulatory risk. They potentially do, but as opposed to other players, they actually have regulatory tailwinds. So broker like Angel One, it will never get the valuations of 80 90 times price to earnings, because firstly there is regulatory risk. SEBI is always trying to crack down on the F&O retail volumes, and secondly, the growth is very very cyclical. If there's a bear market, people can reduce their trading by 50 60 70% as well. That has happened in the past, in bad times in India. But these AMCs have a very good base, that even if new flows maybe slow down for a quarter or two, the old flows are very sticky, right? People don't have to keep trading like with a broker for them to make money. The growth rate might slow down for a couple of quarters, but it is like a subscription revenue for the AUM you already have. So an AMC is basically a consumer facing distribution mode company, with very cyclical revenues traditionally. But right now, as of the last bear market, the cyclicality has gone down a lot. And that is the main reason that the valuations of these companies is probably going to re-rate to almost double the valuation that they currently have. And this happened in the US as well. There was a very extended domestic flow driven bull market from 1991, around that, to 1999. So the index did not correct more than 10% for this decade, and it was a very flow driven market, that the market was basically going up every quarter little by little because there was a lot of flow coming in. And uh, the asset managers there used to trade at 10 11 times, and they were in a few years trading at 30 40 even 50 times. And these were the leaders. So some smaller players growing much faster were trading at 70 80 times as well. And you can check all of this. This is basically, you can just ask chat gpt as well. It'll tell you that this re-rating happened, and it was a very sustainable trend. It was like every quarter they would grow faster than the industry. They would have 20-30% growth, and that is where large money was made. uh, you did not even have to pick the best player. You could have thrown a dart, and you just have to pick the right sector for a few quarters, and it worked out well in the US. This changes industry wide, so you don't have to study every company in depth necessarily. You should actually, but you don't need to. You can just, if you believe in this trend, you can basically have a few stocks randomly from this sector, the leaders, and you should do better than the index if this thesis plays out, that is. So in India, I already told you that June numbers came in very strong of the SIP data. So the market will give valuations based on the visibility of the earnings growth. It has to be earnings growth, yes, but for the market to discount this today, for the price to go up today, this growth in the future has to be visible today, right? That's an I. So let's say this is a 10-year growth that is going to happen in the AMC industry, and the market will basically increase the price of these companies today in the next few quarters, and it will discount the next 10 years of growth today by basically increasing the valuation, provided that this growth is more visible. And the only thing I'm noticing is that after the last episode of the market correction, this growth of the next 5-10 years, it is becoming more and more visible, and which is why I make a case that the market should essentially assign a higher multiple to these companies. And because the June numbers came in very strong, that should also correspond with the revenue this quarter of all these companies. So if you wait around for the revenues to actually come in, you might be a bit late, because every month the SIP inflow numbers come in, and you have to basically track those and not wait for the quarterly earnings to come in. And when times are good, as we saw in US, this creates a chain reaction. So every quarter, these AMCs will have more flows, and the market will, as a result, rise. And the market rising attracts more flows as well. So it's a self-fulfilling, not a prophecy, but yes, it's a self-fulfilling mechanism that once in motion, it's very hard to stop. So because this SIP flows have hit a new all-time high very quickly, you'll see that the corrections in the market will also be very shallow. Every dip will be basically bought up, and that will further increase the confidence of investors, leading to more flows and leading to basically more growth. And of course, this will not just keep on going forever, but I think it's a decent risk reward play. Again, not a buy or sell recommendation, but that's what I think. That it at the starting valuation of 25 to 35 times trailing earnings, if there is a decent bull market ahead, long term for India, these companies should be trading at like 60 or more times trailing earnings, because the very nature of the business or the revenues is changing, that they are becoming more like a subscription model company. So the crux of the matter is that the nature of the revenue of these companies is shifting fundamentally from being very lumpy to now being more smooth and predictable every quarter. So market should essentially reward that, and these are all very liquid companies. You can expect big funds to also enter these companies. So these mutual fund guys who move the market the most, they have the large money to invest. They will be the first ones to realize that okay, the shift is happening. So it should not take very long for this re-rating to happen. And of course, you have to manage your own risk. So fundamentally, AMC businesses are very asset light. And if there's a sudden growth, let's say they were earlier growing at 10%, and if there is more money coming in and they're growing at suddenly 30%, that is fine for them. They don't need to hire many more people. They have a lot of fixed cost. They have an office, for example, that cost won't go up because there is more AUM suddenly. They're not, you know, like banks that they cannot grow too fast, and it's not a higher risk basically. So they don't have to set up new capex. They don't need to even, roll out new funds. They can have more AUM in the same fund. There's no limit that you can only have this much AUM in a single fund. So they can basically take in all of this growth of the next 10 years overnight. They don't have to do any investment, and there is no time that is required. That is the main thing. That so if a cement company has to increase capacity, it needs money, yes, but it also needs time to basically start production. That is not going to happen here. So this change will be visible in numbers very quickly, basically every quarter. Now, of course, there is no risk-free trade. You have to track competition. Uh, the entry barriers are very substantial, but it is not like new players cannot come in. So even brokers like Zerotha, uh, there is basically Angel One who wants to get into this business. There is so all of these wealth managers, they're also getting into the asset management business. They're launching their new schemes and all. So, and there's a big player like Geo Finance. I would totally track Geo Finance heavily because they have a very good distribution. And in this business, distribution is everything. It is not how good of returns your funds can give. It's how many people can you reach. That will, basically decide your AUM. Okay, in telecom, there is not a lot of switching cost. So if you're paying a subscription to Bharti or Vodafone, you can easily switch to Geo if it's providing a slightly lower rate, and there would not be a lot of switching cost. But in the mutual fund industry, firstly, the management fee is not very large. It is large, but it does not look very large to the consumer. So if it's a 1% fee, you cannot entice the consumer by offering 0.5% fee uh, and taking market share that way, because if the customer has to switch the fund, they'll have to sell this existing fund from, let's say, Aditya Birla AMC. I have a fund, let's say, assuming in Aditya Birla AMC, and I have to sell this fund to get into the Geo Finance fund, new fund. So I'll have to pay the capital gains tax, and I don't want to pay that. No one would want to pay that unnecessarily. So the switching cost is very, very high because of this tax treatment. You cannot switch without tax implications, and distribution is also very hard to disrupt. I'm not saying GeoFinance does not have a good distribution; it has a very excellent distribution, but it is not going to use that distribution to take away directly the market of the existing players, but it might expand the market a lot, and as a result decrease the market share of these players. But it could also be a long term positive, that the market expands as a whole quickly because of investments made by Geo Finance. So let's say in paints, what happened was that there were a lot of new players, so Asian Paints could not grow faster than the industry because the new players took away some market share. Same is happening in cables, but this is still like 5 to 8 quarters away, because any new capacity that you set up, it takes some time for that to go live and for production to actually happen. This is not the case with the AMCs. If there's a new AMC, Geo Finance, they can launch the fund today and they can start taking away market share from today, right? There's no gestation period of the capex. I don't think it's an actual term, it's just something I made up, but you get the point. It does not take long for disruption to happen here. It's You can do it digitally, right? Geo Finance has a decent distribution digitally. There is still a lot of relative change, and if the competition risk does not take away a lot from the market share of these existing players, the market as a whole should do good, and the market should also re-rate these companies based on the change in the nature of the revenues. So earlier, as I said, the revenues were very lumpy. You could not guess that okay, next quarter what will be the flows, because if the market dips 10%, the flows per basically they would vanish. But that is not the case anymore, and they're still trading at 25 30 times earnings, consumer facing free cash flow companies. We can see it around us that equity as an asset class is evolving. People are trusting it more. And you might say that okay, you cannot compare India to US. That you can argue that if India has a population of 140 crores, you can say that okay, more than half of this population does not even have money to invest into mutual funds. And that is true, that is fine. But the real penetration is not new demat accounts opening up. The real change that will benefit AMCs, to be clear, is, so let's say there are 10,000 HNIs, the top 10,000 people in India, which control the majority of the wealth. So these 10,000 people will likely already be exposed to equity, but that exposure is like 5-10% on average. Okay, so most of these people have money in real estate, in gold, whatever, in FDs as well. I've seen that even very rich people will put a lot of money in FDs, and that is changing. So if, as a percent of net worth, these very ultra rich guys, if they were putting in 10% in equities and now they move it to 20%, that is a 100% growth, right? And with still a long way to go, they can easily reach 50%. So basically what I'm saying is, as there is less and less unorganized and uh, basically cash money, so because you cannot put cash into equities directly, you'll have to put it in real estate or something. So those guys can also shift their money from, and that will also come in equities. That is also a large tailwind not talked about a lot. uh, so yeah, all these factors make these AMCs very attractive as of now. But my views can change. Everything is on a quarter to quarter basis or even a month to month basis in these cases, because the flow updates are very critical. You do not want to see flows slowing down substantially. That will uh, so you essentially want to see flows making new highs every month or every other month at least. And as long as that happens, I don't see why the market should not reward these companies. So that is all. uh, Again, the listed players in the space is HDFC, Nippon, Aditya Birla, UTI, AMC. These are all decent companies. And there's also a new IPO coming in of, I think, ICICI AMC. They just filed for the IPO, I think, a couple of days ago. So that will be around a 10,000 crore IPO. That's also a pretty big player entering, the listed space. That will be interesting to watch as well. So yeah, overall the space looks good. There is new entrant, disruption that is possible, but that has to be tracked. You should not be basically scared out of it just because a new player is entering. You have to see, are they taking market share away or not? And the market will show you that, right? If the price does not perform as you would think it should, maybe that's also a sign to check whether this disruption is actually happening. And these are very liquid names, so you do not have to worry about getting in or out of them whenever you want, basically. So yeah, that is it for this video. We'll probably track some new space or a new investing framework in the next video.